Peter, let's kick off with Harmony's second quarter trading update. The stock closing down almost, well, it's not closed yet. It's 2 minutes past 5. Short while ago, it was down 2% at 75 Rand 70. We have heard that their production will be lower as a result of the fact that they are mining a lower grade ore. They have said, however, that the 11% increase in the Rand gold price will impact their bottom line positively.
Well, the gold price is like the knockout punch in a boxing match. You can go 14 rounds and be losing on points, but if you can land that punch, it cancels everything else out. And the gold price is that to the gold shares. If the gold price goes up, it cancels out bad management, bad labor, strikes, industrial action, lower grades, higher costs. And that's what we got this quarter. Yeah.
But it's the Rand gold price that we need to focus on, because that's been lagging the dollar gold price.
Well, look, if you're in America, you'd be talking about the dollar gold price. And if you're running a gold mine in Fiji, you'd talk about the Fijian gold price. But you're right, it's the gold price in the currency that you're mining in. So, yeah.
Let's talk about the dollar gold price and the fact that we are holding up at $1,094 an ounce. It's remaining relatively range-bound given the dramatic fall that we've seen in platinum today, around about $34 lower. Does this mean that we've got a solid base in the yellow metal?
You never know for sure, but it does look like it. I think a lot of us were very suspect the way it was running. 1,000, 1,100, 1,150, 12, 1220, and you could see it tried big in 1220 a couple of days. I just felt this is no place you want to stick around. But this 1,100 level is different. You're right, Bronwyn. It's been here a long time now, and it doesn't want to stay below it. You know, it falls maybe to 1090, 1085. It's right back up to 11 the next day. I think it is building a base here, and it's acting more now like a monetary asset, whereas platinum is probably tied more to the economics of the auto industry, jewelry demand. So,
Deryck, I seldom speak to market commentators, fund managers that are positive on gold miners in the country. And I think, if I'm correct, you also stand on the side of those that are not so bullish where gold stocks are concerned.
100%. For me, gold stocks are more of a trading area of the market. But I think the sentiment around in gold at this stage still remains bullish. You know, if you just look at that gold price, it has had a fantastic rally, and I think any welcome weakness that we've seen from that 1220 level back to these levels is welcomed. So I'm still bullish on the gold metal, but as it comes to the fundamentals surrounding the actual gold stocks, I'm not so crazy about them. I think it's not a space in the market that I look to structure a portfolio around.
This is the start of the quarterlies. Can we expect pretty much the same picture from the other gold miners?
I think so, Bronwyn, yeah.
Of the gold miners, Goldfields, Harmony, AngloGold Ashanti, is there any entry point, Peter, that you would prefer, or would you stay out of gold stocks completely?
Look, there's always a time for every stock on that board. And Harmony is looking pretty cheap. I don't think it's been this cheap to the gold price, maybe a couple times in the history of man. It's very, very cheap relative to the gold price. It's pretty low relative to the gold index, which means it's lower than all the other gold shares relative to the index. So, and the gold index is very, very low to the all share index. So you've almost got three factors that are getting quite stretched. And I've said this before, and I'll stay consistent on it. I would be buying a little bit of Harmony here, because if the Rand blows out, Harmony's the best geared, and it's already greatly oversold. So you've got a lot more corrective margin here. And we just see on the operational side, Briggs is doing a lot of creative, positive things, closing down low-grade shafts that are just losing money. And at this gold price, if you're losing money on a shaft, you probably should close it. And those are very old shafts he's closing, the Mary Sprites and the Evander ones. So in the meantime, even if gold stays flat, the Harmony management is doing proactive moves.
You mentioned Harmony's management team, Graham Briggs. What about Mark Kutufani and AngloGold Ashanti? Isn't he one of those brazen gold miners out there saying that AngloGold Ashanti is offering shareholders value over the longer term?
Look, I won't say he's had his day in the sun, but Mark he hogged the limelight for about, what, 2 years? And he deserved it. He did a lot in 2 years. I couldn't believe one guy could do in 5 years what he did his first year. But he was buying back all these gold hedges at $700, $800, $900, $1,000. But you got to say, Mark, maybe it's time to change. You know, don't run a good show too long. And I think it's going to be hard for him to do much more. He's done so much so far.
Let's go to general equities now, and according to Sanlam Investment Management, the majority of South African fund managers believe that local equity market is overvalued after benchmarks climbed by more than a third last year. 52% of money managers surveyed by Sanlam Investment Management think that the market is expensive relative to future earnings, while just 2% think that it is too cheap. This is a debate that we have had extensively over the last couple of weeks. Are earnings going to justify current share prices, Deryck?
At the moment, I personally don't think so. And again, we've worked off that extremely low base. We're now looking forward into 2010. We've got a bigger base to work from now. Are earnings going to surprise and start to give you reason to buy these stocks at these levels? And just looking at simple PE valuations, I personally believe that the market is slightly too expensive. And we are seeing this first pullback of 2010, and we are seeing a bit of weakness at the moment. And through December, January, or through the beginning of January, we had very uneventful trading. So there was a very significant move that was in the pipeline and waiting, and we're starting to see it. It started last week, Wednesday, if I'm not mistaken, and we're seeing the sell-off now. So I think we're starting to move in line with valuations that, for me, need to come down. In terms of the all-share index, I think a fair PE valuation would be towards 24,000 for me.
2% of fund managers, according to Sanlam Investment Management's survey, think that the market is too cheap.
2%.
2%, but I mean,
which is 2% of the people believe in flying saucers and the Earth's flat. Why are they wasting time putting ink on paper for 2%?
Is there any chance that the market is too cheap, in your view, the South African market?
Yeah, there's probably about a 2%. Yeah, there's probably a 5% chance the market's too cheap. But if you're investing people's money, you want more than 50-50 odds on your side.
If you're investing people's money, what strategy would you be embarking on right now?
A very conservative strategy, very balanced portfolio. We've been saying this for the last 3 months, and the Aussie's done nothing in the last 3 months, except it's continued to outperform the US market. I think our all-share index is now at a 30-year high, which means if you just put money in this market at any time in the last 30 years, you've done better than having money in the US market. Now, a song that's played for 30 years, I think it's time for another record. So I'd be very wary now of keeping a lot of assets in this market that's outperformed the US for 30 years. And we've had metal prices running for 9 years. We've had the dollar weakening for 9 years. We've had interest rates worldwide coming down for 9 years. I think it's time for a change. And I'd be looking not an exit strategy, but a real diversification strategy.
Do you concur with that view? Diversification is on the cards right now. Take a conservative view on equities?
I think you have to, Bronwyn. At this stage, like Peter said, we've had such a strong run. And if you look at the bigger picture, the 30-year picture, we've gone up gradually and consistently over time. And we've seen these commodities prices spike drastically at the moment. And for me, it just went up a little bit too much too quickly. And it's just a signal for me to take a couple of the resources off the table, perhaps just build up a bit of a cash buffer. And although it might run a little bit more, you might miss out on a potential 10% upside. I think a conservative approach is important, and you've got to highlight the importance of being able to have cash to take advantage of the market at lower levels.
Peter, I like throwing contrarian views at you. Adrian Saville, Cannon Asset Managers, on Business Tonight recently said that there is a possibility that the US dollar could fall by 50% over the next 10 years.
Well, that's a pretty safe assumption. You look at 15 trillion debt and the willingness to keep interest rates at zero. But to fall 50% from this level, you've got to say, and what's the rest of the world going to do in the meantime? Are they going to stand back and let the US lose 50 and they stay strong? Then they lose all that market share. There's a lot of countries in worse shape than the States, and there's a lot of countries as bad shape as the States. That's kind of been my thesis all along. When the dollar was 160, now it's what, 140? So he says the dollar is going to weaken 50% in 10 years. Yeah, it might, but against what? Everything? Something? Gold? Can he be a little more specific?